Signals are a powerful part of the system, and you need to recognize signals. I have this video is about signals and how you can read the indicators to take advantage of recognizing those signals, when to get in or when to get out of a trade. In this particular example, I've got three vertical lines drawn. My setup is typically how you would see it. The left chart is the price, zip, and swing chart, and the middle chart is the candles with the trend chart and the power chart on the bottom. And then the weekly chart follows that, and then the fourth window is, of course, your data window. And I'm going to show you that today the market is open right now, and this is August 14th, 2017. And a couple of days ago, we had this, I marked on this chart the vertical green line. And on that particular day, it closed at $2.05, and it opened the following day at $4.14. So it gapped up over 100%. And this is a stock in which you don't see that kind of gap very often, at least from a percentage perspective, but it is significant. Also significant as well is that on the green vertical line day, there were 45 million shares traded. And on the red vertical line day, there were 26 million shares traded. So, and then the day before that was 13 million, and on the Zion day, there were 6 million shares traded. So there's significant volume taking place here, and there's a lot of traders that trade on volume. And that's an obvious way to pick up or to search for opportunities, but we don't technically trade volume. We trade indicators. And on the vertical green line day, as you can see, we're in a sky touch situation. And if you're not familiar with it, there are in the three patterns that we use to identify gaps. Specifically, I'll talk now about gaps up. We have the identical indicators, we have the down touches in the trend chart, and we have the proximity group patterns, both location and shape patterns. And those three patterns have conditions that we need to maintain in order to have the qualifying or the required conditions that create the pattern. Like, for example, the identical indicators have to have 12 out of the 22 MFR indicators in an identical shape. You can have one or two or more patterns. Typically we deal with one or two, but you can have three. But in a two pattern group, you would have 9 patterns in one, like 9 BOC patterns, and 6 patterns in another, like a right leg W, higher pattern. And that 9 and 6 is 15, and it's more than 12, which then qualifies it or puts it into having the requirements for the identical indicators. You have the down touches in the trend chart, and that's what I'm referring to here. We have 6. First of all, the trend red, green, and gray are your fast lines, and they can down touch 6 qualifying areas or lines. And those 6 are the trend trio, the blue, pink, and yellow line, and the 0 line, and the area under 0. And the 6th one is a sky touch. And although this is not a sky touch, it's basically a gap up from a continuation pattern. And so all the rest of the situations are going down, or at least the indicators are going down. But with the sky touch, the indicator in this 1 out of 6 example is going up. Those 6 qualify as a down touch in the gap up situation. The sky touch has 5 possible conditions. And there is the day that the trend red crosses over trend green, that's the crossover day, or the next 4 days after that. If you look at this particular example here, you can see that on the vertical Zion line, trend red has crossed down under trend green. And so the day between the Zion and the red line is the crossover day. And then the red line is the first day and the green line is the second day, and we can go to 4 days on a gap. When you and we look for different things associated whenever we're in a sky touch situation, because trend red is above green, so we're in a continuation uptrend pattern. But one of the things that we'll notice, and I'll point that out right away, is the divergence that's in the on the vertical green line day. I'll start over here in the price chart, and on the vertical green line day, trend green is price green is 130 and price red is 131. So price green is going up, as we can see, faster, but it didn't make it over the trend red line. It's the following day that it makes it over the trend red line. So green on this day with our peak, the green has crossed over. Oftentimes when you see that, that will be the high point. The crossover day of the green going over the top of the red will be the highest point or the peak of that day, of that particular movement. And it's not always the case, but oftentimes that happens, just like it appears it's going to be happening here today. This obviously is August 14th, 2017, but we are only a couple hours into the market. So we could get a little bit higher green candle there, but not likely to be much based on what I see at the moment with the way lines are continuing to drop. However, now with that, I'm going to move this green vertical line back to the day before the gap up, and we see that zip green has hit 100 on that day. And that is in itself is not significant, but what is significant is that it is above the zip pink, which makes it qualify as a pattern, a pink-green top pattern, because green always has to be at 100 and pink has to be up against the green, next to it, closest to green, and going up. And with that, those conditions, that qualifies as a possible next day down pattern. As you can see, pink is now going 2 more days past that, so that does not necessarily mean that the value has gone down. I mean, obviously it goes up because of the gap on the day after the vertical green line, but now on this day we have what we refer to as a diving board. In other words, price green has gone under the zip pink, and zip pink, if you're not familiar with it, is the price barometer along with swing Zion and the 3 price lines. And whenever you have price red and green, like right in here, high above the price blue, you're basically in an uptrend. Prices are going up, and in this case they hardly ever get I've very seldom seen price green beyond 150. It can go up there, but it'll oftentimes be up there for only 1 day and drop back down. I have seen it above 150 for 4, 5, 6 days. It's highly unusual, and it hardly ever even gets to 151. Literally caps out at 150. So in the 140s, it's reaching its peak. It will reverse back down in the 130s, the 120s, even up to 100 or 90 and go back down. Just depends on the conditions. But your range on the price red and green is caps out at 150. Now, on this day, the vertical green line day, we had swing Zion up, swing pink down. That's a divergent condition that tells us something is going to happen. Again, divergence does not identify direction. Divergence identifies opposition of strength in the market. There are two types of methods that we use to identify strength. That's indicator line length and divergence. There are dozens and dozens and dozens and dozens of examples of divergence. And there are a few different types of indicator line lengths, but I'm not going to go into those right now. Also in this example, we have Zip Zion is climbing up. It's above 50 also. That doesn't mean that it's going to be continuing in that direction, but it's going in the direction of what we're anticipating to be a gap up, because we've already established that we're in a sky touch over here in the trend chart. The other, oh, by the way, I started with the price chart, and I wanted to just share with you, it's not a divergent condition because green did not pass over red, but it was very close, so it implied that it could be going over, but that was not a divergent condition. The next day, when it crosses over, that becomes a divergent condition because of the crossover. Because remember, you have 3 price barometers on the price chart, and they're coded slightly differently, but when they are all representing which way the price is going, when one crosses over the other, that little bit of difference is a divergent condition, or at least what we refer to as a divergent condition. One of the other things that I'll point out that's significant in this movement between the red vertical line and the green vertical line, which would give us our ability to identify a gap, Zip blue and yellow separation. Zip blue is at 26 and zip yellow is at 11. That's a separation of about 2 to 1, a little over 2 to 1, 26 to 11. On the green vertical line day, zip yellow is at 15 and zip blue is at 50. So they are 35 points apart, or you might say zip yellow times 3 is still less than zip blue. So now on the green vertical line day, we have a huge separation between zip blue and zip yellow. This is definitely what I refer to as a divergent condition, because zip blue and zip yellow almost always travel together. They will typically probably average 3 or 4 points apart, depending on the price of the stock that you're looking at. Like if you're looking at a $20 stock versus looking at a $200 stock or a $1 stock. There can be slight differences in the way that it runs in different stocks. But the separation typically runs around that 3 or 4 points, and it from 1 to 3 or 4 points. But now they're separated significantly. In this case, 3 times yellow is still less than what blue is. So that tells us something. What it tells us is that there is the potential for more, but it also tells us that when they come back together, or when they start to come back together, they are going to it's going to cause a significant price movement. When they separate and when they come back together, those are the issues that you have with zip blue. And how they and in the diff, we refer to it as the diff separation. DIFF stands for difference. It's a part of divergence. When you look at the different, all the different aspects of divergence, and so this is an example of that. The other divergence that we have is right down here in the power 4 lines, or power 5, I might say. Power 4 is pink, blue, white, and yellow, and you can see that pink and blue are going up, and if you look down here farther, you can see that white and yellow are going up between the red and the green lines. Zion is going down. So we have divergence between the power 4, pink, blue, white, and yellow, and Zion. And it's referred to as directional divergence. We also can get divergence with power Zion underneath orange and the power 4 above orange. And when we have both divergent, when we have both location divergence and, and directional divergence, that gives us significant price movement. Excuse me, I'm hiccuping, and I hope it stops. All right, now the final type of divergence that I want to refer to is my favorite, and that is trend red is up and power red is down. This is my favorite because you can see, when you see those two in opposition, you need to remember that they are two powerful, the lines that are the power that those two lines represent is very significant. It's greater than some of the other lines. And we use power red and trend red and swing Zion as the big three in identifying and tracking three, I'll say, sets of powers or groups of power, or however you want to think about it. When those three do something together, like those three are all in a BOC higher, or in a BOC pattern, that's great and significant because it can be a real strong next day up or a nice 2, 3, 4, 5 day uptrend. When they're in, if they're in something stronger than that, like a BOC higher pattern, then it's even better. But when they are together and moving in the same shape together, that is significant. Now, even though we have, even though I'm not considering or looking at the Zion, because Zion's either going up or down, it really doesn't make any difference, I do always look at power red versus trend red when I'm looking at an opportunity. And when I see that, it oftentimes leads to a gap, and it oftentimes leads to additional divergence. And I'm honestly not certain if it's the power of trend red being opposite the power of power red, or if it's the combination of all of that, and power red is just identifying other types of divergence as well. Because we can see what the indicators do. We can recognize their leading indicator abilities, telling us what's going to happen before it happens. But we have trouble identifying specific, you might want to say, well, this is the A power, and this is the B power, and this is the C power. Those different forces within the market, we can't identify them by name. I mean, I'm not sure anybody can, but we can identify the strength of the movement. Right when the movement starts, on the day that it starts, we can identify oftentimes the 3 to 5 day uptrend, and we can identify the pullback in that 3 to 5 day uptrend. And we do it primarily through the down touches and the up touches in the trend chart. And so this example here is of a sky touch, and it gives us a lot of information about what's moving, or how it's moving. Keep in mind, on the green vertical line day, this is the first day that the trend trio has crossed over 0. Trend yellow is at 8. The day before, on the red vertical line, trend yellow was at minus 13. So these lines are moving, how do I say this? The difference between, you've got 13 under and 8 over, so you've got, that line moved a difference of 21 points. You can have, the yellow can cross over the 0 line, trend yellow can cross, trend yellow can cross over the 0 line, and it can be 0.5 and go up to 0.4. So you can see that was a much different movement than this one when it goes from 13 to 8. So you need to think about difference, DIFF, difference in divergence as well. These indicator lines will tell you powerful information, but you got to look at them. The other thing that I want to point out is that on the Zion line, the trend red has crossed under the green line, and then we would have, and then from there it crosses over. If red was down and it did not cross under the green line, then that we count the days after that as well in the sky touch. But it's basically done on an analysis in this way. We look at the day that it went down, and then the day that it started back up. And the day that it started back up, trend red was above green on both days, and so we consider that day when it starts back up. That's the crossover, or what we would refer to as the crossover day of the sky touch. 99% of the time, red crosses over green, but occasionally you'll see this pattern and red will not cross under green. It'll be on top of green, and then it starts going up again and then gets into your sky touch. And again, we're looking, I mean, keep in mind, you've got a sky touch on the day before this red, but you didn't have the supporting information that went with it to identify a gap. You don't have those required conditions within the down touch trend chart patterns. So lots of information. This has been, I concentrated on a down touch there, but I showed many signals on what causes us to identify and see gaps. And divergence is a big one, but it's not the only one. So keep divergence in mind. Always look for divergence. As you look, or as you become familiar with the system, you're going to realize that the proximity patterns, the proximity location patterns, will appear generally in one area for a specific type of pattern. Like they might always be above power orange. Or, what I'm trying to say is that you might have a handful of positions or locations that the power 4 or power 5 lines, that would be Zion included, they're generally in a normal spot when you see that gap up. Likewise, shapes for specific patterns might normally appear in the same 3 or 4 general shapes for a specific pattern. And so you're going to get used to, or you're going to be able to see some patterns more quickly than other patterns, and you're going to find yourself trading those patterns more often. And that's good, and especially if you're tracking your trades through trade logs and identifying what you're doing and how you're doing it and why you're doing it. That's very, very important if you're going to be have a significant level of success trading. So it's this is technical analysis at its finest. And we are excited about the day trading Visual Basics system. I think it's quite obvious that you can see that we can identify strength within a market movement. We can identify the conditions, because you have the required conditions, you have good conditions, and you have the extra conditions or the supporting conditions. There's 3 types of conditions. And supporting evidence conditions, or that third one, is what it drives gaps up. And like everything, you can be talking about the gaps, or you can be talking about the other movements, like a one-day up pattern, which is a red spike. That's a one-day up pattern. Unless you got supporting evidence to go longer than that, get out by the end of the day. Then you've got the good conditions that support other patterns with those good conditions that give us the uptrends and give us the multiple day movements. And then you have the 3 gap patterns that all have to have certain required conditions. It's best if you have good conditions, like all 7 of the short-term trend lines are going up when you're going to go long. You can obviously they're not all going up when you go long, because the gaps are pushing down and then they gap up. So, but the third one is those extra patterns. Like, for example, when I said I had 9 BOCs and 6 right leg higher W patterns, higher right leg W patterns, that was 15 identical indicators in a 2-pattern group. But you could get a red spike in the zip red and yellow. And that's an additional pattern that is supporting evidence, and you only need 1 or 2 additional supporting evidence within the 3 pattern and gap analysis to give you nice big gaps. Because you can get gaps with the required patterns of each of the 3 pattern groups. But when you find more supporting evidence, then you're going to get greater price movement typically. So it's amazing. We're excited about it. We I just know you see the potential here if you've had a chance to listen to any videos at all, because it took us many years to put this together. But it truly is a fantastic system, and we know that if through the use of this system we can help you to become more knowledgeable and more independent and more confident as a day trader.